Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course, and I help to make it actionable, understandable, and clear. When it rains, it pours. I had more worthwhile news to share with you this week than I have had in some time. Unfortunately, the producers want me to cap it at 16, 17, 18 minutes. So I'm going to do the very best I can to high grade what comes your way so that you're equipped to make the right decision this week and the week after and the week after and the week after. On tap today, we're going to just a quick chart look at the tariff snapback. So stocks are basically back. Remember all the calamitous news you read about how tariffs were going to end the world? And they very well could have, but looks like we've got a lot of changes in the works there. We also are just going to give Mr. Warren Buffett some credit. He is announcing his retirement at 94. He finally saved up enough to retire. Proud of him. And then we have some wonderful Wall Street Journal articles. Mr. Jason Zweig talks about how your money market fund is ripping you off. Wonderful. I love this by Mark Holbert. Guess how much time many investors spend on researching stocks. Wall Street Journal. Wonderful. And then we end with Morgan Housel, one of the luminaries of our day in personal finance. And it's just a reminder of how beautiful simplicity can be. And when you have someone with the cerebral horsepower of Mr. Housel, it definitely is an encouragement when we can doubt. We can start to believe that complexity, it's in complexity. That's where the real intelligence is. No. Mr. Housel clears up that for us. Let's do a quick chart work. If we look at the American stock market and we say to ourselves, okay, what's been happening year to date? You're almost back to even. Not totally. You're about 3% under. But if you look at the snapback, stocks are up about 15% in the last 30 days. 15% in the last 30 days for VTI, which is Vanguard Total U.S. Stock Market Index. That snapback is a wonderful reminder to us all. Good luck moving in and out of the market. The market was discounted, presumably, because of all the tariff talk, and then it snapped back just as quick, presumably, because we think these tariffs won't be as significant as we first thought. So don't try and move in and out of the market. What a brutal thing that would be if you let's say you go to cash and you look back and go, whoops. Oh, it's a hard game. Let's start with the Wall Street Journal, Jason Zweig. Your money market fund is ripping you off. I found this fascinating. Mr. Zweig talks, Mr. Zweig shows some of the underbelly of the industry. I'll confess, as I mentioned in last week's episode, with the improvement of these artificial intelligence engines, and I've been testing them just about every week as a new model comes out. Grok 3, Gemini 2.5, 2.5 Pro Research is incredible. The better they got, I had a moment last week where I thought, I think a large part of what I'm doing, the AI will eventually be able to do, which I still think is probably true. But I was given great encouragement when I read this article by Mr. Zweig, because it's not just an answer engine that you need a guide, and this will explain why. Money market funds, believe it or else, have continued to have high fees. As you'll recall, the expense ratio is the manner in which the cost of a product is expressed. So as a percentage, so if someone, if you have $100 in a fund, it charges 1%, it's $1 a year. Well, what happened, money market funds have grown a lot. So since 2015, the article explains, they've gone up by more than 150% in terms of the assets under management, from 2.75 trillion to 6.91. Wow. So you'd think, wow, okay, with more money, you'd have lower expense ratios. Not the case. That has happened in stocks in a big way. In the 90s, Zweig reminds us, and I can't even imagine how bad this must have been. Annual expenses on stock funds were 1% to 2%, just base package. Now there are more than 50 ETFs that charge 0.05% or less. That is an incredible reduction in cost. It's called the Vanguard effect. Google it, AI it. It's the Vanguard effect. Ask your ask your favorite AI engine or agent, what is the Vanguard effect? I bet they nail it. However, annual expenses at money market funds have gone up, even as their assets have boomed. What's happening? I did not know this. This is fascinating. We get a little local shout out here. So what occurred is, all right, these companies are trying to make money on money market funds. So a Dallas-based Texas Capital Bank, I didn't know they did this. They launched a money market fund ETF. Did not know that. It grew quickly to $40 million. And BlackRock iShares this February has 2 money market ETFs. So if you're not at Vanguard, these could be interesting. But listen to what happened. Listen to the underbelly of the industry. These funds got booted off platforms. Schwab kicked Texas Capital's ETF off their platform. Can't buy it. Fidelity pushed that ETF and 2 iShares ETF off its platform in March. Yeah, they're really for the individual investor, aren't they? Yeah, not exactly. What does that tell you? You need a guide. And maybe the AI agent can be a good guide for you. But I think this is just what we see. I think there's probably even more going on that we don't see. So these platforms booted these innovative low-cost products. Booted them. So that, why'd they do that? They want their product with margin. They want their closed ecosystem. This is where, when you look at the landscape, and I have the big 3 in my mind, it's Vanguard, Fidelity, and Schwab. These are these brokerage platforms where you can place money. I think all 3 are fine. You've got to be sharp with all 3 now. They will try to sneak in products to you that you don't need at prices you shouldn't pay. So Vanguard, because it is a not-for-profit in a sense, its money market fund is actually reasonably priced. 0.11% is the expense ratio. You don't get that sort of pricing at other places typically, or they're trying to kind of shove you into their higher priced offerings. Schwab is notorious for seeking to put your unused cash in what they call their little cash sweep account at 0.05%. Fidelity does a little bit better. They've got better default cash options, but we've got to be sharp. We've got to be wise as serpents, innocent as doves when we're dealing with these intermediaries. This article was a wake-up call to me that, boy, howdy, that's some just sharp elbows right there. Very sharp elbows. It's still the best of times. Still so much better than it was. Next article. This article was just so helpful in us understanding why we are bad with money. Headline, guess how much time many investors spend on researching stock buys. Subheadline, it's a lot less than you think, and a lot less than, this is probably why. This is Mark Holbert. I want you to guess, how long do you think the median investor spends prior to purchasing a stock? Now, they went back. How would you research this? How would you even know this? Well, they had incredible access to data. So this is Tumas Laritas and Jeffrey Wergler at NYU Stern School of Business. Maybe some sort of a feeder school for Texas A&M. I'm not familiar. They were able to do incredible research by looking at click history. So they I guess these people must have allowed for them to do this. Hundreds of people allowed them to look at their browser history and click history so they were able to see what screens they were looking at and then time it. So they only spend 1% of the research time, I won't tell you the answer, on risk statistics. 14% of the time on earnings, dividends, and fundamentals. 73% of the time is a price chart One day, a price chart. So most of these investors are essentially, in summary, looking at a price chart, and that's it. That is the extent of their understanding of these companies. Wow. Whoa. Do you know how long it was? 6 minutes. 6 minutes they spend before clicking a button. Wow. And now, before we just get on our high horse, I can totally relate. As humans, we almost assume that we know more than we do. Oh, sure, ExxonMobil is a company, and I've driven by their gas stations, and I know I'm familiar with. They drill wells, and they've got refineries, and then you see a price chart. Ooh, it's wow, it's down, or it's up, or hey, we'll buy here. I can understand and relate to that. Now, I would like to extrapolate this. This is one study. What I think is also true is this is, of course, I don't recommend individual security selection, stock selection. I want you to buy index funds. I think that's way better. What if we were to do another study that said, how much time do investors spend on their personal finances? That's right, on ensuring you optimize your personal finances. Now, of course, I would just hire a guide like me, and you're going to fast track everything you do, stay out of trouble. But my expectation is that it would probably be equally shocking. And why is that? I think as humans, we want to enter arenas where we feel competent and we will win. We want to get, and in personal finance, we don't always feel those things. We feel a lot of barriers. We don't always feel competent. It can be frustrating. And then the changes are brutal. They make you do these, if you want to move your money, it's tough. And let's say you've got a friend managing it, you got to make a phone call, and then you got to tell your CP. I mean, there's enough. Inertia is this powerful force in the universe. It keeps us stuck. But I bet it's just as shocking how the small amount of time that investors spend just optimizing their finances. And you think about all the other places where we will spend time. A new car purchase. I recognize this is different for different people, but rightly, a new car purchase, you spend some time on. But what's more important? Personal finances, the new car purchase. Of course, the personal finances, of course. So let's try to change that figure up a little bit. Not be so caught up in quick fixes. And then Mr. Housel. This is ETF.com. What a website by Mr. Sumit Roy. And it's an old article. I went searching for this. It's a headline. Morgan Housel doesn't need to beat the market. You can probably put your name or my name in there. Best-selling author uses index funds, dollar cost averaging, and simple strategy. I mean, this is probably why this article is so old, is you can only write it once. Can't come out with this one every week. Hey, just in, Morgan Housel still isn't trying to beat the market. No. That's not what gets the clicks or the eyeballs or the advertisers. So, but listen to this. Morgan Housel, one of our favorites, he wrote The Psychology of Money. He's a partner at Collaborative Fund. He says, this is just a great quote. He says, I dollar cost average in index funds, and you'll remember what dollar cost averaging is. That's a regular purchasing pattern of securities over a period of time, which I think is fine. I like lump sum investing more, but it's fine. He says, I dollar cost average in index funds. My net worth is a house, a checking account, and index funds. I'm going to repeat that. My net worth is a house, a checking account, and index funds. He's simpler than me and probably all of us. He has one checking account, only index funds, one house. Doesn't that sound nice? Housel says there are so many people who cannot accept that strategy. They can't understand why someone would not try to beat the market. He says he has no aspiration to beat the market. And this is the quote that I think, of course, you would expect I would love. He says this, if I can earn average returns for an above average period of time, it's going to achieve every financial goal that I have. It's enough. And I think that's an interesting and helpful distinction. You want to be above average, just not in your returns every year. You want to be above average in the time, that time horizon long, that moniker we always repeat. He says, if I can earn average returns for an above average period of time. So you do want to be above average. So if you ever get pigeonholed or made fun of at the water cooler for seeking to be average, say, oh, no. Not the case at all. I have grand ambitions to be above average, just in different categories than you. So you, the straw man I'm inventing, who wants higher annual returns than the index provides. So you want to be above average in your annual return. I want to be above average in my time horizon. We both want to be above average. I just don't think your methodology using data proves out. You'll be very kind about it, I hope. Be very kind. So it's a great encouragement when someone intelligent like Mr. Housel says this. And then this is the part, he moved the needle for me with his thinking on cash. I will confess, I've always looked at those charts on, if you have $1 and I think there's a dollar in 1800, what's it's worth today. If you just kept it in cash, it's something like 4 cents. It's this incredible erosion of value due to inflation. That's a big, and so you look at a chart like that and you're like, oh, I guess I must run from cash because of what a terrible thing. Well, Mr. Housel goes back to that desire. He want to be above average in what? Well, that time horizon. Well, how do you do that? How do you, if you don't just trust that your own mental fortitude and toughness and inner strength will get you there, what are some things you can do? What sort of environmental factors can you control for to make sure you have that long time horizon? Here's what Housel says. I like to save like a pessimist and invest like an optimist. Save your money and have a level of cash with which you can absorb and manage and survive all of the unpredictable nonsense in the economy, but invest your money like an optimist. If you have a higher level of cash, Housel says, then the odds that you'll be able to hold on to your stocks through thick and thin goes up. Everyone looks at a high cash balance and just looks at the opportunity cost of that, but they're ignoring that if having high cash increases the odds that you will hold on to your stocks forever and not get forced out during a bear market, then the actual return on the cash could be enormous. Ooh, what a line. The actual return on the cash could be enormous. So what Housel's saying is, Robert, you're thinking of a dollar and 1800 is 4 cents today. That's actually not the return on cash. It's preventing those forced sales during bear markets that keeps the stocks invested. That's part of the return on cash that you're not measuring for. Oh, I never thought of that. Now, this is where Housel takes it further than me. Cash is about 25% of his portfolio. I think I read him another place. About 20% of his net worth is in cash. Whoa. Who can argue with it? He's got a pretty sound reason for why he's doing that. He knows full well the dangerous effects of inflation. He's not being an ostrich and sticking his head in the sand. He knows what's going on. So what a great reminder by Mr. Housel, an encouragement to us to keep those costs low, that investing simple, and our time horizon long, because that's what's going to give us the best shot on our investing journey. Until next week.